Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. And today's question comes from John. Alan, in January, Abbvie spun off from Abbott Labs and I owned a few hundred shares. I sold the $45 call for 89 cents and then bought it back for 45 cents and sold the next month's option for 60 cents. I was wondering what you think of this company as a covered call stock and the trades that I made. Well, John, basically what you're telling us is that you didn't specifically go out and select this company, kind of fell into your lap because of the spinoff. So let's first take a look at the actual trades that you made, then we'll evaluate the company and try to come to some kind of conclusion. Well, first what you did was you got ABBV as the ticker symbol, and I'm going to make the assumption that the price was approximately $45 and that you sold the near the money $45 call because the return was about 2% for the month, so that would make more sense than a longer term option. So let's make that assumption that you bought the stock or it was worth about $45, which means the $89 per contract represented a 2% 1 month return. So far so good because that annualizes out to about 24% a year. Now, you closed it at 45 cents. So what that tells me is the price of the stock was higher than the strike price. Otherwise, why would you roll the option? So you bought it back for 45 cents, but you only sold the next month's option for 60 cents. So if you did it at the same time, what you have to factor in is the debit and the credit and whether that makes sense. Well, here we had a credit of $60 per contract, a debit of $45 per contract to close, and that left a net credit for rolling the option of $15. Now, our cost basis is going to be the current value of the stock, which is $45 due to the option obligation. Even if the price of the stock, which it was higher than the strike, we still have a value of 45 because of the initial obligation. So that represents a 0.3% 1 month return for rolling the option. That's less than a half of 1%. Now, if that's enough for you, then you should go for it. But to tell you the truth, if you're using covered call writing and you're going through the process of selecting a stock, selling the option, managing your positions, you really should demand a higher return than that. At least in the eyes of this trader. So anyway, that being said, that's rolling the option. That's one thing. You did generate a 2% 1 month return initially, which is great and fine. So let's take a look at the actual stock itself and see if, aside from rolling, this is a good candidate for covered call writing. Now, in the chart screenshot in front of you, I have a chart that I created, and it has an interesting picture associated with it. Because as you could see from the arrows, price of the stock goes up, it goes down, it goes up, it goes down. It doesn't have a smooth price pattern to it. And that's a reason why the beta, or the historical volatility of this company, is 1.95, which means that it's twice as volatile as the overall market, or the S&P 500. So the more volatility means the more risk terms of buying and selling. It's less predictable. So that's already one strike against this company, because if you're a covered call writer, you're a conservative investor, and the more predictability, the better you feel about things and the more comfortable you are. That's a general statement about covered call writing. Of course, it does not apply to everybody. So let's next take a look at the Smart Select ratings, which is one of the screens we use in the BCI methodology. And here you could see that of these 6 rankings, only 3 of them meet our requirement for those green checklist circles, which means that it's right at the top, one of the best performers in that category. The other 3 categories, yellow and red, do not meet our strict screening criteria. So from the vantage point of fundamental and technical analysis, it falls short of some of the stocks we find on our premium stock list. So that's a second strike against this company as far as a covered call writing candidate. Now, next I created a screenshot of the actual $45 call option so you can see what happens with the price of the option as the price of the stock goes through all those gyrations that we just took a look at. And you can see the same thing occurs here. It goes up, it goes down, and it has actually a 1 month price range of 30 cents to $3.25. So in terms of buying back the option or getting your timing right, it becomes less predictable than other option choices that we have. So all in all, as far as a covered call writing candidate is concerned, I definitely have seen better. But let me just give you a however here, and there's one caveat I want to add. If this is a company that you want to keep in your portfolio long term, you can use covered call writing to increase those returns. And that's a strategy that I talk about in my books and DVDs, which I call portfolio overwriting. And that means you have no intention really of getting rid of the stock. You want to hang on to it, but you also want to pump up the returns. So what we do in cases like that is we sell out of the money calls. We normally like the price of the stock to be about 5% lower, at least 5% lower than the strike price that we sold. And then, of course, we consider rolling the option if we have an in-the-money situation as expiration Friday approaches. More details on that strategy in my books and DVDs, but that's slightly different than the conventional or traditional covered call writing that I write about in my material. So there you have it, John. Is it a top performer for covered call writing? No. Can you use covered call writing to enhance the returns if that's an equity that you want to keep in your portfolio long term? Absolutely yes. So you have to make that decision whether or not this is a stock you want to hang on to for the long term. John, thank you so much for that question. It was certainly an interesting one. And thanks to all of you out there for watching this video. I hope you found it interesting and useful. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.